This is where you get ambushed. When these bear markets occur, quite often it's events that come out of nowhere, seemingly. I think we're headed for a different situation than any other downturn we've had in the market.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. After the tariff tizzy that sent stocks falling earlier this year, the markets are back at all-time highs and seemingly nothing, not U.S. involvement in the Middle East war, nor growing pushback to Trump's big, beautiful bill, nor a weakening consumer can cool Wall Street's red-hot optimism right now. So, is this bull rally justified? Have we put the uncertainty and volatility that defined the first half of this year safely behind us now, or are investors too confident? For a market veteran's perspective, we're fortunate to be joined by technical analyst and author Michael Oliver, founder of market research firm Momentum Structural Analysis. Michael, thanks so much for joining us today.
Good to be here, Adam. Thank you.
Well, it's a pleasure to have you on, Michael. This is the first time you're coming on the program, so it's nice to meet you here and welcome. I am known for asking this intro question. I haven't asked it much of late, but because you're brand new to the program, let me ask it of you. What's your current assessment of the economy and financial markets?
I think that everybody's focused on this news story, then suddenly that news story, then this one. Nobody's focused on what has happened. In other words, markets, if you go back and look at bull market tops and in the subsequent bear markets, you'll find out it's not because of what happens in the future. It's because of usually what has already happened. And if that what has happened before is built on error or overpricing and things of that nature, then the correction's going to occur, or the bear market's going to occur anyway. So the fact that there's a headline or not a headline to give an excuse to why it's going down, which, we had the tariff issue in the first few months, and now then it's suddenly a new war situation. We had one Ukraine-Russia thing in March of 2022. To the 2024 high. 2009 to 2024, the NASDAQ 100 went up like 19-fold over 15 years. You go back in history, at any bull market in U.S. history, none has matched, one, the duration or the dimension of that move. S&P went up about 9-fold. Same story there. And you say, well, the economy was good. Okay, well, Trump said it wasn't because, Biden was in charge and Obama, et cetera. So, but anyway, forgetting that, you look at an M2 chart and you can see one of the reasons why the dollar valuation of the S&P 500 went up, because the dollar's true value went down because the money supply basically doubled every single decade. And particularly in that 15-year period, we had some new things that the central bank used, like QEs, to really help goose it. So they printed money. And then when they adjusted rates in a fixed rate type environment that we live in other words, rather than a free market pricing of the cost of money, we have a central bank that tells us what the price of money is and the quantity. And they priced it at free for 10 of those 15 years. Money was free, okay? Not only was it abundant, it was free. So, I mean, this is Cheech and Chong time. Hallucinations, bid for what you want, everything goes up, it's glory, we've had 15 years of that. And the technicals that we look at, not those fundamentals, but that's what we're aware of. The macro technicals that we use are momentum based. We look at price, but it's secondary to us because we know it's distorted by the underlying money units, whether you're measuring in yen or euros or dollars. As those money units ongoingly decay in real value, the price of things goes up. For example, we ran a chart recently that was so laughable, I hope it made its point. The Venezuelan stock market. You've never seen such a vertical beast. It's lovely. We should invest in Venezuela, right? No, it's because of the degradation of the money unit, silly. The only issue here is, well, it's less so, okay. But it's still a ongoing degradation of the money unit, therefore the number of dollars, et cetera, et cetera. Okay. Once error is built into a market, let's say, you make a decision whether you're buying stock or whether you're building a company or hiring new employees or your state government going to spend it on roads. The cost of money is a major factor, the price of money. And if money is free, then you pretty you spend, and it doesn't seem to have a negative impact. Ultimately, you have to pay the bill. Now suddenly that's an issue. And it may not be an issue in most investors' mind, but in ours, we can see it. And we're watching sectors that most people aren't. Most people are looking at the Mag 7, which, by the way, aren't mags anymore. There's about two Mag 7s left. The
Hmm.
others don't look anything like a Mag 7 stock in terms of where are they on the map. Uh, but sectors like commercial real estate, few people even talk about it. We used to know about the mortgage market back in 2005, 6, 7. Finally, the error hit in 2008. It exposed itself. This time around, look at commercial real estate. It's not a topic, but even yesterday was a good example. Commercial real estate got whacked about 2% while the market was up, make it pushing toward new highs. Look at where commercial real estate is, the price charts even. Go back, 10 years or so. Look what happened in 2022 when the market made a high. So did commercial real estate. Then the market exceeded that high. Commercial real estate didn't, went lateral. There's errors built in there. And when these things pop up, it makes headlines and it ambushes people. No, it's not a war story, anything like that. No, it's not the tariff issue. By the way, that hasn't gone by the way. We're not
Hmm.
talking about it anymore, but there's no deal with China. Okay, so yet we forget about it. So anyway, what do I think is going to happen? I think we're going to have a major bear trend. And I think it's not so much that the stock market goes down, but economic reality exposes itself. Errors, failures, and so forth. Here, there, everywhere, especially in places you aren't particularly looking right now. That's the environment I think we're in. And despite the teasing rally in the S&P and the NASDAQ, which by the way is not being reflected by the Dow Industrials, the Russell 2000, consumer discretionary sector, healthcare sector, all these sectors are nowhere near their highs. And yet everybody, oh, new high in the NASDAQ 100. Oh, S&P is going to make a new high today, probably, as we're talking. It's 10 points
Hmm.
away. You know, I recall, pardon me for being long-winded, but back in 2000, we called a top in January. This is the dot-com high. First trading day in January, we said, this is, get out, be gone. This bull market's over. Okay, well, what happened? It dropped into February, March. Next thing you know, in late March, it made a new high.
Hmm.
Wow, it's so nice. A handful of percentage points. Dropped again, went back up again, made a new high monthly close in August. So 6 months after we said get out, it's still blah, 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 sideways. It took till 2021 and a Fed rate cut to really get it going on the downside. So often stock market tops are doing what they're doing now, teasing you with a comfort zone. I don't think it'll be comfortable when it's over.
Okay,
All right.
so great intro. Thank you. So it sounds like, Michael, you think market direction is much more dictated by the sins of the past versus expectations of the future, even though we all think it's about expectations and we react to every headline. But you're saying it's much more important about what happened in the past. Given what happened in the past, as you've laid out for us, you say you expect a major bear market trend to emerge going forward from here. On the economic side, you said economic failures kind of everywhere. So I sort of hear that as sort of like recession. Is that a
Yes, yes. Oh, yeah, yeah. No, I'm with Jamie Dimon on that. He's got his own reasons, fundamental reasons. We have our technical reasons to state that one, we got bearish on the S&P in January of this year, not far from where we are right now, just a little
Mhm.
bit below here in price, and more so in March. And then finally we had the puke into April, and they had a headline with that. Oh, now we have a reason. Okay. And then Trump like waved a wand and said, no, no, 90-day pause. And it was like a shepherd dealing with an upset flock of sheep that were scrambling all around. And he said, "Oh no, everything's fine." And they all got back in line and moved it back up again. And now suddenly it's not even an issue. I don't even hear him talking about tariffs. Now it's the Ukraine, I mean the war thing, Iran. What the tariff issue is not over, but that really isn't the issue either, because that's a new event that came. In fact, it wasn't even an event when Trump got elected. It took a couple of months before it became a forefront event. The real factors are simply the overpricing of the market based on free money for 15 years and the errors that are built into that type of thing. Not just stock market prices, but business decisions, family decisions to, hey, dear, let's build a new house, a bigger house. We can afford it. Rates are cheap. Now suddenly those issues come to the fore. And in other words, past reality comes, it has dues to be paid.
Yep.
This is what happened before, the the dot-com people were screaming for years, this is going to change your life, internet. And you know what? They were right. It was far more fantastic event than what even they were claiming at the time. And yet the NASDAQ 100 dropped 82% between 2000 and 2002. Why? Were they wrong? No, they overpriced themselves.
Right.
Anyway, that's where we are now, except even more so than ever in U.S. stock market history.
Okay, so then I take it it's not just recession you expect ahead, but it's also a very substantial market correction. I mean, obviously,
Oh yeah, no, I'm not sure how deep the market will go. I mean, you could go back and look at history 29 to 32. I mean, it's like an 80% wipeout ultimately. And it began with a crash and then came all the way back up, halfway back up into March of 1930, and then went down slowly for 2 years, but an 80-something% drop. And it took until 1953 to even get back to the nominal price high the Dow saw in 29, not counting the degradation in the money unit. Similar thing happened in 2000, by the way. People think, oh, wow, the stock market made a low in 2002. Great. But in 2013, for the S&P to finally take out those highs, the 2007 highs and the 2000 highs. So you had a decade and a half almost of terms where the market was a wasteland, really, in a range. Anyway, I think we're headed into that, and I think there'll be real world consequences. And one thing we said about a year ago is we thought, well, if Trump wins, a couple things are likely to happen, but one of them is likely to be uncopacetic in terms of public response. And I mean, the opposition, rather than sitting back on their haunches and waiting for the next election cycle, I suspect if we get economic downturn now that is noticeable to the average Joe, something he thought Trump wouldn't bring on, Trump is going to save the economy. Well, if all of a sudden that doesn't happen, then emotions come into play, sense of uncertainty. And when that happens, and we know people are hurting on their credit card limits and so forth and so on, we know these data points. We know commercial real estate is in a stranglehold right now. In fact, we had the biggest shopping center in the country. I think it was an $800 million default on debt 2-3 months ago. Wasn't a headline, but it happened. That you can get uncopacetic things in the street as well.
And okay. And by copacetic, you essentially mean civil unrest, correct?
Yeah. In fact, there have been polls done by University of Virginia Department of Politics about 2 years ago. It was. They polled both likely Biden voters and likely Trump voters. If the other side wins, is violence justified? And it was an incredibly high percent, like 20-something% on both sides. And yes. If the other side wins, is that the end of democracy? It was like a 40% odds on both sides. Yeah. In other words, this wasn't a normal election. We're at a point now, if you throw into the mix economic pain and suddenly a sense of disbelief, like, well, we thought, Trump got labor vote, he got to low income vote, who thought this guy can probably solve our problem. He's sort of down to earth. And if all of a sudden that turns out not to be the case, Not so much because of what he does or didn't do, it's what has already happened. He just stepped into it. If that unfolds, as we argue it's likely to, then a sense of emotional disbelief occurs. And that's when you get that uncopacetic, unpredicted outcome where all the norms aren't there anymore. And so that's another element that I think is probably we're going to see it this year, especially if we're correct on the stock market, relapsing from a new high, like it did by the way, in 2007. You made a peak in May. Where was it? Back at the same price as the 2000 bull market peak, 1550 on the S&P. You drop from May through August, a hard drop, just like we had January through April.
Mm-hmm.
Bernanke during that time denied that there's any problem with the mortgage markets. It's totally controllable, he said.
That subprime is contained. Yep.
Yes, right. You remember that. And the market turned up in August, September, moved back toward the high. And in mid-September, he cut rates by 0.5 point. Surprising rate cut, by the way. Was not anticipated. The market shot up for another 3 or 4 weeks into mid-October, taking out both the May high of 2007, just above 1550, and the 2000 high, just above 1550. It got up to 1575, like 1.5% into a new high. Fed rate cuts, everything's going to be great. That was the end of the world. We went to hell for the next 2 years.
Yeah.
And reality hit. We had a mortgage crisis. Now it's probably not a mortgage crisis so much as it's a corporate debt crisis and other issues. But same story. Don't be teased by a new high.
All right. So lots to pull in there. I guess let me just ask here about the corporate debt crisis, because you think that may be one of the big contenders here for why this rolls over. We had corporations, I think, understandably, some might say wisely, when the Fed started to hike rates, they went and borrowed as much as they could while rates were still low. But we are now approaching that debt maturity wall for a lot of these companies. Rates have not come down. And so it's funny, there was a lot of worry about this like a year or so ago in the headlines. I haven't seen much of it all recently, but I believe that we have somewhere around close to $1 trillion re-rating this year and similarly next year. Is that when you expect a corporate debt crisis? Is that the main trigger? Is that the balance sheet is re-rating?
It's been a trigger. Yeah, it's been underway actually for a couple of years. If you've seen the movie The Big Short,
Sure.
you remember they had 3 or 4 guys, separate parts of the country, analysts, independent of Wall Street, who came up with the same conclusion that shit's going to happen. Okay. In other words, this is built-in crisis. It's going to happen. They knew it was going to happen. They could see it coming.
Right. It's math.
Yeah. But look how frustrated they were. They were seeing this in 2005, 2006, 2000. It wasn't until 2008, even after the Fed cut rates finally, that it began. And they were right. So you can have that crisis. For instance, the long end of the bond market, the 30-year bond futures we look at. We got bearish on T-bonds back in October of 2020. Then the T-bonds were above 170. Between 2020 and late 2022, they dropped down into the 110, 115 zone. A huge collapse. A lot of it occurring late in 2022. But since late 2022, you can draw a line sideways on price, and you've done nothing but this. In other words, it's been in a choke zone in terms of yields really dropping. They haven't dropped. They've stayed high. And of course, the yield chart would show it the other way, up, at high levels.
Yep.
But it's not that they have to go higher to choke people. They're already choking. It's just that they won't relent. And as you said, maturity, 2025 and 2026, as I understand, is likely a time for a lot of these debts to be exposed in terms of the ability to pay or not. And so, we could be nearing that crisis. And yet it's been a reality that's been there for a couple of years. It just won't go away.
Yeah. Let me ask you this, Michael. So we've got that going on in the corporate world, and obviously on the national side, finally,
The
we,
government,
we
yeah, the government crisis that's a new thing. Yeah.
yeah, but I mean, finally, at least we have a national dialogue about the debt. This is something many
Yeah.
of us had
Yeah.
worried about for years, and just nobody cared. Now there's actually some awareness of how bad the deficit is and how it's contributing to the debt. But let me ask you this on the consumer balance sheet side. So there does seem to be an increasing amount of data out there that show that the consumer household is increasingly struggling. Um, and a big factor of that has been, while during COVID, when there were all sorts of different interventions, a big one was forbearance programs on all sorts of different types of debt, as well as giving people money, which many used to pay down
Yeah.
debt with it. Now that those stimulus are long gone, the debt balances that got paid off are back to all-time highs. Obviously, this debt is expensive now because rates are high,
Mhm.
right? Um, but I think an important recent development has been the last amount of debt to go back into repayment was student loans, right? And student loans, as you know, can't be dismissed in bankruptcy. So like you got to pay that loan.
Yeah. Yeah.
And what we're seeing is delinquencies and defaults are spiking like crazy on student loans. In fact, the data we just got said that we're seeing the highest delinquencies in student loans ever. I think it's something like almost 1 in 3 are in delinquent right now.
Mhm.
And what we're also seeing in relation to that is that other forms of consumer debt delinquency are starting to rise too, because people are like, well, I got to pay this new student loan that I wasn't paying for the past
Mhm.
bunch of years. And so maybe I can't pay off my credit card. Maybe I can't pay off my auto loan in full. Maybe I can't pay my mortgage in full. So it seems like, do you agree that I'm seeing the consumer part correctly? And if so,
Yeah.
do we have this sort of triple whammy of
Oh
debt
yeah.
stress, both on the consumer, the corporation side, and the national side,
And the national side too,
or
which
the
is
sovereign side? Yeah.
that's even bigger. And the T-bond market is, that's the government debt. Okay. And you look at that chart and say, this guy has tried to get up out of here so many times in the last 3 years, get a rally going, drop rates, rally the price, and they've all failed. We had a good rally going, for example, back in Jan, Feb, March, April of this year.
Hmm.
Bonds rallied from like 114 to 121 very sharply. Nice rally. And thought, oh boy, we're on our way, right?
Yeah.
Within 2.5 days, it was back down to 111. That's a crash. What happened? I mean, you can't do that with the government debt market. The central bank has to be panicked to the point of wetting themselves without admitting it publicly, of course. They thought, oh, everything's fine. Well, a government debt market is not. And so you now have a problem you didn't have in 2008. Now it's come to the fore. I mean, so many decades of this error compounding and compounding, and even Trump has increased the situation. The debt is increased under his budget. So they may be talking about it, as you said, but nobody's doing anything about it. And I,
Right. Well, on the day we're speaking here, the latest news on the big beautiful bill is
yep.
that they're stripping out a lot of the cost savings that were put into the bill. Trying to make some of these Doge cost savings permanent. So,
Mhm.
to your point, at the end of the day, it just
Yeah.
seems like more like business as usual on
Yeah.
Capitol Hill.
No, I think we've got a crisis coming, and it's not just stock market, but it's in the real world. And I think that crisis this time around, unlike 2000 to 2002 or 2007 to 9, is going to create the kind of changes and uncertainty and up in the hands type response by everybody. Like, what the hell's going on type thing. To where we're going to lose, which is fine with me, some institutions that have been around for 100 years. I'm betting you won't have a Federal Reserve. Not because Trump doesn't particularly care about it one way or the other, and a lot of Republicans don't, but because it's dysfunctional. And there's a lot of people realizing it's really been a boom bust cycle generator. Not just the Austrian School of Economics, but others are saying, this really thing hasn't worked well. They're always behind the curve, et cetera, et cetera. I also think if you see that pinching effect that you're talking about, or the choking effect of debt, particularly personal debt, income taxes are in question. Not so much because some Republicans just soon get rid of it anyway, but because it's dysfunctionality in terms of the source of government revenue, which it's become more and more every year in terms of the revenue that it generates as what was expected is less and less. And there's a point at which people simply say, oh, I have to request a delay, or oh, I need a plan. I'm driving around town and I'm listening to Sirius radio, whether I turn on CNN or Fox Business News or whichever. There's constantly ads about we can help you with the IRS.
Hmm.
That's like 50% of the ads. Well, I didn't know there was a problem. Yes, I do. But I mean, that could be the kind of crisis where all of a sudden income taxes are abolished. Not so much because they intellectually like the idea to do it, it's just that it's dysfunctional. And they revert to a national sales tax. Let the shopkeeper collect taxes for the government. All these kind of changes could occur. And I don't think there'll be a surprise. There'll be a surprise for many, but I think this is different this time. I think the world, it's not just the US. I think a lot of countries are going through major change or about to, especially if we enter the kind of crisis we're talking about with the stock market down, the data points will go with it. Day-to-day life will change, much like it did in 2007 and 8, if you
Hmm.
recall. Uh, Argentina is an interesting example. Um, you mentioned I did a book. Well, 50 some years ago, I wrote a book on anarcho-capitalism. I defined what the concept was. Uh, the president of Argentina, elected like a year ago, Javier Milei, is an anarcho-capitalist. And he busted both parties in the election with the youth vote. And a lot of the vote that he got to become elected president was desperation, especially young people just throwing their hands up in the air saying, this stuff hasn't worked for decades. This two parties back and forth, still a socialist state, turned Argentina into a third world country, used to be the seventh biggest economy in the world, 50, 60 years ago.
Right.
And then he comes in and what is he doing? He's abolishing stuff. He got rid of rent controls. Suddenly rent prices have collapsed, which makes him happy. But he's throwing away notions that have been around for decades. He's tossing them. And it's sort of an emotional, not on his part, he's an intellectual, but on the public's part to vote for him. It wasn't like they read what he thought and understood it. It's just that they knew we need to get rid of these two competing parties, which have brought us nothing but ongoing decay. And once you get a market downturn and the personal pain that goes with that, like we've been talking about, personal debt and so forth, you get this sense of desperation where it's hard to predict what the outcome's going to be, but I bet it's not going to be just another boom bust cycle. It's
Hmm.
going to be something far more lasting.
So let me ask you this. So first off, a lot of what you say has a lot of similarities with the concept of the fourth turning, put out by Neil Howe, which I'm
Uh,
sure you're familiar with. Yeah, you're nodding here. So, and I've interviewed Neil several times, and so everything you're saying is pretty consistent with him, right? The fourth turning is when your institutions that have, basically been
Mhm,
there for the
mhm,
previous three turnings get replaced because they're no
mhm,
longer serving, and
mhm,
there's a new order that emerges from that. Now, obviously, they tend to be pretty tough times, right? And it seems like that's what
mhm,
you're expecting from here. So let me ask you this, and I know I'm asking you to. This is just, postulating. Um, so, I would argue that e- 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 except when times are really good, um, economics tend to drive people's voting decisions when you get in the voting booth.
mhm,
If you're not feeling well financially, that
mhm,
tends to be the thing weighing most on your mind. And I think that largely is why Trump is back in office here.
mhm,
After the huge spike in cost of living,
mhm,
um, there were some other factors, but inflation was at the top of the voters list from the polls when they went to vote.
mhm,
Um, so, it's now to your point, Trump's got to deliver on this. And if he doesn't, right, and all those constituencies that he brought under his umbrella, the working class,
mhm,
whatever, they may say, look, we gave you your shot, you didn't help us out, we're
mhm.
going for something different. Um, well, let me ask you this. So we just saw earlier this week, um, New York, the results of the New York Democratic primary, right? Where
Hmm.
they went for a young, like dyed-in-the-wool Democratic socialist, a guy
Hmm.
that was just promising a lot of free stuff.
Yeah, mhm.
Is that where we go next in this unwinding, where
That's it.
if people give up on, the current what's currently on the table with the Trump administration, is it just, look, things are going to hell and I may as well get some free stuff while they are?
Yeah, well, it could be some of it could go that way, no doubt, and some could go another way. But I just think main thing that's going to happen is the notion of the institutions that have prevailed really since the early 1900s. Before that, it's different, but yeah, especially since let's say Hoover and Roosevelt onward, the two-party system. I've often had this image in my mind of a totem pole, the growing state, big capital S
Hmm.
state. And the two snakes that twirl around it. One's Democrat, one's Republican. And it really doesn't matter which one's in control for this 4 to 8, 12-year period. The same growth occurs. It's ongoing. You might have a guy who says, oh, like a Reagan type, who says, I want to cut it, but he really didn't stop it. It's continued to grow. One excuse after another, rationale for this thing, that thing. And yet the
Right.
government
But
is
at the end of
bigger.
the day, the special interests and the privileged classes benefit, and the public just gets a
Yeah,
little
yeah.
bit worse
And
every time.
ultimately, when that fails, it's like tabula rasa. You can't quite predict what's going to happen. Although I tend to have a very optimistic view that is that over time, and maybe a lot of time, history will evolve in a positive way because they'll use bad ideas, create bad institutions, they'll suffer from it, and they'll finally shrug that off and go to something else. And ultimately, they're moving in, let's say, the right direction, even if it's a fumbling process. Of
Mhm.
course, it could span like,
Kind of the strong men create good times create weak men, weak men create bad times, and
yeah,
then bad times create hard,
yeah. But
yeah.
anyway, I think we're headed for a different situation than any other downturn we've had in the market. It's not so much the market downturn; it's what's connected to it in the real world, so to speak. Uh, the average guy's life, the notions of government, um, what it should do, how it functions, how it raises its revenues, all these things are tossed up in the air to the point where it's hard to predict what's going to happen. And I'm sure that election you're talking to, the primary, was a surprise to many, especially Cuomo, an institutional statist, all of a sudden
Hmm.
upended by a guy who's even more of a statist. But, you know, uh, rather than the Democrats evolving toward a Trump view, they went the other way, in this case. And who were the voters? As I understand, they're young college educated kids who are in heavy debt and can't afford to live there, you know. So they went that way. Well, I question that that's the right direction, but they threw their hands up in the air, is what I'm saying.
Yeah.
On a micro basis. Uh, there are, for instance, throughout the country right now, there are counties that are wanting to secede from states. There's many counties in Oregon that want to secede and join, I think, Nevada or Montana or something.
Yeah. I'm in
And
California. We've got several too in the northern part of the
yeah,
state.
yeah. Illinois, there's some. I mean, these are people that say, I don't like the central government of this state. The direction is this way, and we want to go another way, less taxes, et cetera. And these things are popping up like crazy, and they're getting votes. So, you put some financial pain onto people's backs, not just what they're suffering now, but sharper. Especially, it'll be associated with the stock market fracturing. That helps create emotion. And then all of a sudden, it's hands up in the air. And I can't predict the outcome except to say it's not going to be the same this time. It's not going to be, oh, well, the other party is going to win the off year election. Yeah, something different is going to happen. And it's going to be hard to predict what that will be, except to be ready for it.
Okay. Well, let's talk about that in just a moment in terms of how to be ready for it from your perspective. Um, Before we do though, let me ask you this. Okay, so I understand where you're coming from. Port turning makes lots of sense. Sounds like you think that's going to start really ramping up here. Um, Put on the bullish hat for a moment, right? So to the people, so the administration would say, Michael, look, we hear some of your concerns. We're working really hard. we're revamping trade, we're deregulating, we're cutting taxes, we're doing everything we can to stoke economic growth, and that's going to start showing some results, probably starting the end of the year, heading into the following year. Um, we've got AI coming. That's going to make American businesses, super productive. Um, we've got record corporate profit margins right now. They're really flush, so we don't have to worry about, layoffs coming anytime soon. Um, what would your rebuttal be to that narrative?
Well, I don't, the Trump arguments sound good on paper, but tariffs are taxes. So you said about lowering taxes. Well, when you apply a tax to a transaction international, that's called government intervention in free trade. Okay. So they don't like doing that on a domestic basis, but when I buy a product from a guy who made something in China that I like his product and he'd like to get some money for it, that's a transaction between him and me. Okay. Uh, and for the government to intervene and say, no, we're going to price it at this level, that's outright government intervention. That's a socialist type thing. If that were done domestically, they would renounce it. The Republicans would,
Hmm.
but they're doing it on a foreign basis. And there have been some critics of this, within the Republican Party who've
Yeah.
noted that intellectually this isn't making trade better. This is interfering in transactions between.
Yeah, and let me just make a quick
Go
point
ahead.
on that. You can continue. So I've talked to Art Laffer, who has been advising the Trump economic team. He's a big free trade guy. He doesn't
Mhm.
love tariffs. That said, he is not. He doesn't mind using them as a leverage point to get better trade negotiated. And if you listen to the administration, they talk about, non-tariff trade barriers. So, threat of the tariff, but really at the end of the day, I don't necessarily want that much of a tariff from you if I can get you to open your market to our products and we can sell more into your
Mhm.
population. And therefore, net net, America's getting a better deal before, or sorry, after than it was before. So does that change your opinion at all or not?
Any interference like that in the pricing of trade between A and B, whether it's within the same country's boundaries or external, is in effect socialist slash fascist intervention. Mussolini wrote about this. He was actually a socialist, by the way. Most people don't realize that. If you read most of Mussolini's writings, it was focused on government doing exactly this type of thing, where government bands together church, the state, unions, business. That's where, the back of your dime, there's this wheat thing with this
Right.
shafts. Okay, that's the fascist symbol.
That's sure.
Uh,
Yeah.
and that's his notion of don't take over the companies like Marx would have you do. Instead, control them through regulation, price controls, uh, control of their labor force, what products they put out, what they price them at. Uh, you have a free market? No, no, you actually, well, it's a form of that. It's merely one aspect of it. And the fact that it's between, if they're charging us too much for a product, then we'll buy less of that product. You know, it affects the pricing level. If I don't mind it and then I pay it, versus a product made in another country with a different tariff, maybe a lesser one,
Hmm.
then I will determine where I'm going to buy it from, me, the consumer, or a company buying thousands of products from a producing company in China or somewhere else. It's an issue of the relative pricing of them versus somebody else. So if they're charging too much and their tariffs are too, et cetera, that's a market decision. And market pressures will force them to go the other way at some point if they find that, you get the point.
Yeah.
Um,
Okay. So, but basically, it sounds like
okay.
you're not selling what the administration. You're not buying what the administration's selling.
No, no. Superficially, it sounds like, oh, they're free market folks, but no. It's again the two snakes around the totem pole. We've heard this before about, we're going to reduce government and all this, and yeah, it never happens. Continues to
Okay.
grow. There's always
Okay.
an excuse.
Yeah.
Um,
So how about the whole, AI massive productivity boom coming to America, all that?
could very well be just like the dot-com boom was dead right. Okay. they were correct. I mean, the internet was going to change your life, and boy, did it. Again, far more than they thought. Uh, but their bubble broke. Why? They overpriced that reality for a while, and it took them 16 years for the Nasdaq 100 to get back up to its 2000 price level. By the way,
Right.
okay.
So given that we are at kind of close to all-time highs in terms of equity valuation metrics,
Oh yeah,
CAPE
yeah,
ratios, Buffett
yeah.
ratio, whatever, do you believe that there is an AI bubble in the markets right now?
Yeah, I think there is. I think the leadership is already, the Mag 7. I mean, Nvidia just made a new high, okay, by a few dollars above where it was a year ago. And frankly, if you look at an Nvidia chart going back about a year and a half or so, you're not really making a lot of money. I mean, most of the gains already occurred well over a year ago.
Hmm.
It's been holding its ground, I'll admit that. And Microsoft looks good too when you look at a price chart. But all of a sudden, we've run reports on this, and even just simplistic price reports, chart reports. Normally, we look at momentum. But the price charts, even the price charts are screaming at you, hey, there's no more Mag 7 anymore, guys. Get a chart of Google, get a chart of Amazon, get a chart of Apple. Are they at their highs? They were in 2024 when the market was making its highs in early 25. Now it's back to its highs, quote, the market, S&P 500, NASDAQ 100. The Dow's not. And so many of these key sectors, particularly consumer related, consumer discretionary, they're not near their highs. And then we're having, fracturing. I can see it technically in the ETFs of the commercial real estate market that people are just not even talking about. This is where you get ambushed. When these bear markets occur, quite often it's events that come out of nowhere, seemingly, that create headlines. And I don't mean a war over some other part of the world. I'm talking about here, where suddenly this company failed. Why? You know, um, anyway, yes, AI could very well be exactly what they think, and it will change the world, but that doesn't mean it can't have a bear market.
Got it.
Okay.
All right.
Yeah,
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 and I totally get
yeah,
the
yeah,
analogy to the .com. Price is what you pay, value is what you get.
yeah,
You can overpay even for a good value in the long term. You can overpay for it today. So, okay. So, Michael, it sounds like you think that uh, animal spirits are driving the markets right now that are not justified. It sounds like from your technical analysis, you're seeing things that concern you momentum-wise. You're
yeah,
seeing
yeah,
cracks that you just mentioned for us. So, what is this? How do you think this? Would you look to the second half of this year, right now that we're
yeah,
entering the
yeah,
second
yeah.
half? What do you see? Like a blow off top, then
No,
followed
no,
by?
I think you've had your blow off top. I think that occurred in that 23, 24 surge that finally took out the 2022 price high. S&P was at 4,800 in uh, early 2022, and then it dropped. And then we came back up, and it took like a year or two to get there. But finally, in 23, 24, you blew through that 2022 price high, and you went up, to 6,000. Uh, yeah, and that was, I think, the blow off surge. Now, this looks like a laborious top. Well, you look at 2007, it was very laborious. In fact, in the last report in December of 2006, we put out a report predicting that the high in the S&P would occur in 2007 between 1550 and 1600. It peaked at 1575 in October, and it took the Fed to do that. I thank them very much for that, right in our target zone. And yet denying reality all during that time. Like the guys in Big Short banging their heads into the wall. Like, it's true, but it's not working. Okay. Well, finally it happens. I think we're there. And you can even look at like I said, price of the market, various other metrics other than the S&P and the NASDAQ 100, and they're not making new highs. They were in 2024, but they're not anymore. So the market is decaying despite the CNBC headlines and the Fox Business News headlines about, oh, a new high. Of course, Trump's got to be real happy because I understand he's a tape watcher. So he thinks that whatever he's done right. And by the way, you mentioned something a while ago about inflation. Let me add this comment. Our analysis of the Bloomberg Commodity Index is that we're about to launch into another bull leg in commodities. And these often occur as assets flow out of the stock market. Look at the late 70s. The stock market was a total wasteland. It went nowhere for 10 years, like kissing your sister. It just went nowhere. In fact, we were losing money because it held nominal value, but it didn't really go anywhere. Commodities exploded back then. Global stagflation we had. And yet commodities exploded on the tailwinds of gold. And I think we're about to face another upturn in the commodity markets. I'm speaking technically now. Um, and I think when that occurs, that's going to really surprise a lot of people who voted for Trump because one of his main issues was I'm going to keep inflation low, price of gasoline, per gallon is going to be kept low. I think he could be surprised by that. And the public would be shocked because that's the one main thing they really voted for him for, is to keep inflation low. Falsely measured inflation, by the way. The real way to measure inflation is growth in the money supply.
Mm-hmm.
That's been getting more aggressive, especially over the last 9 so months, by the way. Nominal price impact of that growth in the money supply, such as in commodities or in the stock market. They don't consider upward pricing of the stock market to be a reflection of inflation. In other words, monetary excess. That's okay. But if the price of corn goes up, that ain't okay. Okay. Heck with a corn farmer,
Mm-hmm.
Uh, so, but I think that asset class shift when the stock market gets wobbly as it is, goes somewhere else. Quite often it usually goes into gold. You go back 100 years and find big bear markets, gold went up. Okay. Why? Because the central bank went to an excess in response to the stock market breakage. Usually T-bonds also go up, meaning yields go down. That isn't working this time. So suddenly you're left with really only one alternative, monetary metals. But I think we're also at a technical point where commodities, which have not been in sync with gold in recent years, are going to get back in sync with gold. And your asset price rise you're going to see is going to be in the monetary metals and commodity category broadly, and stocks related to commodities.
Okay, I was just
Uh,
about to ask that. So, and again, let me just preface this by asking, so you think we've already seen the blow off top, the market's kind of struggling here to go higher. You think that's going to fail at some
yeah,
point.
soon.
How material of a drop? I don't need a percentage, but just
Yeah,
small, medium, big. Do you expect the general equities market to take over the rest of this year?
pretty big.
Pretty.
I
Okay.
don't know that the April low is going to hold this year. Okay. I'm frankly looking for a high. I'm begging for the S&P to make a new high because I want to hear the headlines. Because I know we're going to run reports on this where we simply show people the price charts I've been talking about, where
Mhm.
the market's making a new high, and everything was happy together in late 24, early 25, virtually every sector you look at. Now suddenly it's very limited. Now that tells you something right there. You're losing your leadership too. Your Mag 7 isn't making new highs. Two of them are. The third one's reasonably close, but the Mag 7 aren't Mag 7 anymore. So even that leadership is gone.
Yeah,
Uh,
they say you always kill your generals last, but you're saying we're at the point where they're
yeah,
shooting
no,
generals.
I think, yeah, you've got to notice that because and also some other key sectors that are just too damn big to ignore. Healthcare sector is in a major bear trend. Uh, Apple, there's a structure on Apple when you look at the price chart, look at an annual momentum chart, which we run on Apple that says, you recently they got down into the 170s, 180s, and now you're back up toward 190, 200, right? Okay. I think it's right. Yeah. Uh, you get back down halfway back to the low you just made, and you're going to fall apart this time. Apple's going to implode. So not only the Mag 7 going to get anemic, some of them are going to start to really go down. And this is based on an annual momentum structure. S&P has a similar pending structure. Now, we measure long-term momentum via usually quarterly momentum and annual momentum. Quarterly momentum is when we measure, let's say, the monthly action in relation to a three-quarter average. Not whether you're above it or below it. Sometimes you can weave it, it doesn't matter. But when you plot the momentum chart, you see a different trend structure often than you see on a price chart. Whereas price might look like, oh, it's just an upward curve. When you look at momentum, there may be a floor that's developed. Where if you looked at the momentum and said, gee, if that were a price chart, this looks vulnerable.
Mhm.
I can't go through that floor. I'm going to collapse. Uh, we have that kind of situation that was already broken in that March, April drop, such that the rally we see now, when you look at a momentum chart, is up under the momentum levels that we broke early this year. So if you look at a momentum chart and treat it as a price chart, you'd say, this looks like hell. This is not a good rally. This is up under the point of breakage. Price is nipping a new high. Momentum is not. It's saying, no, you're already broken. This is a counter trend rally. Don't trust it. And I think once they realize that, once you make the new high and everybody's beating their chest, it's when you suddenly start to peel back down again and they say, well, I thought we just broke out. How come we're back now at 5,500 or 5,000? And then that's when the panic really sets in.
Mm-hmm.
And that's the emotion comes into play.
Comes into play.
Yeah.
Okay. So I just want to know this is consistent with Katie Stockton, who I just interviewed a couple of days ago, who also is a pure technical analyst, just looks at the price action, doesn't take macro into account. And she is seeing both momentum fade the way that you are, and she also thinks that lower prices are technically in order. It sounds very similar to you. So I just want to point, there's a point of consistency there. All right. So to your where I'm going with this is it sounds like you think, okay, the risk here is pretty broad-based across the equities complex for the second half of this year. That capital will obviously, if that happens, try to find safer haven. You think this time it's going to be the monetary metals, even more so than normal, because the bond complex hasn't been providing as much safety as it has been in past times. But even as the general equity index perhaps suffers, you actually think that the equities of the commodity producers will actually buck that trend and do fairly well.
In fact, if you look at XLE, for example, the broad oil sector ETF, it doesn't really correlate well to the S&P. I mean, there have been plenty of years in the last 10 where the S&P has gone up and the XLE has gone down. Okay. So it's stock market, but it's really not correlated well to it. It's correlated more to oil market and oil and many commodities are correlated to the Bloomberg commodity index. They tend to move with it. Even platinum, which people used to associate with gold, is only now coming to life again. We've defined a breakout a month or two ago via momentum. But it's because the Bloomberg Commodity Index, if you look at it, after that rally that peaked weeks after the Ukraine-Russia war began, by the way. So the Russia-Ukraine war didn't drive commodities up. They'd already made their move. They doubled. The Bloomberg had gone from 70 to 140, which is still cheap. Back in 2007, it was 237. Okay, so people thought, oh, commodities are off the page. No, they're only halfway back to their old bull high. And then they dropped back down to 100. But for over 2 years now, the Bloomberg's gone dead sideways. Zero decline, zero rally. It's basing. And it's trying to turn up out of here. And if you can close a month, I'll give you the number. Close a month over 106.55, I think is the number. We got up to 107 something a few days ago. Of course, that was the oil nonsense. Which fortunately got hosed down. You close a month out above there, you're going to emerge. And I bet you don't even need a headline to do it. It's just an arm wrestling. It's an asset class movement into a cheap category. It's historically very cheap.
Okay. So I've asked this question in the past where there's a chart out there of the ratio of stocks to the commodity complex, and it's
Absurd.
it's plumbing kind of all-time lows still.
Yes. Yeah.
You think obviously that's going to reverse. Sounds like pretty much big time. And the big question is well, is it going to reverse because the commodity complex is going to go higher, or is it going to reverse because the equity complex goes lower?
A good point. A good point.
And it sounds like you think it's going to be both.
I think it's going to be a combination of both because the net technicals of the Bloomberg argue to us, one, it's massive basic, and that's one that's really going to create upset because not just because prices go back up, but because it totally upsets the political notions. About well, now we're through with inflation. Trump's in there. We're going to drill. Nobody's going to be drilling right now. It's too uncertain. And that's not something you can push a button and it happens. It takes years. So there's a lot of false notions built into people's expectations.
Right. And
And
if
it's
oil's
when,
in the 60s and maybe going lower, those guys
well,
don't want to
or
spend a
if
lot
it
of
slips
capital right
back
then.
up and without a headline gets back up over 70 again, without a headline this time. You don't ever buy war news. And we've
Right.
tried to explain that. If you buy war news, you're going to get trapped. And sure enough, they ran oil up to 77 and then plummeted back down to 64, 65. Now, its recent low was 55, by the way, back in April. But if you start to quietly firm without any good news, just for some unknown reason, and firm back up, back over 70 in this next quarter, assume it's for real this time. And it'll also reflect what the Bloomberg is doing, which means grains, copper. Look at copper behaving quite well. Uh, so I think that that would be a psychological ambush as well, indicative of money flowing out of an uncertain category, the stock market, but also psychological is a sense of, geez, if he can't cure inflation, we're helpless,
Hmm.
and that desperation sets in.
So let me ask you this then. So the precious metals have done pretty well. Gold's had a good run the past couple of years, a strong year this year. We now have breakouts in platinum for sure, and silver,
Mhm.
finally cracked above 35. It's 36 something now, at least futures wise, the day we're talking. Um, if what you think comes to pass, which is, uh, hey, capital starts getting really beaten up in the general equities market, needs to go someplace safer, decides to pick this space. How high the moon here, Michael? I mean,
Okay.
where does this go?
My personal investments are heavily in silver. Okay. Now we watch gold because it's the mama monetary metal. But silver, people have forgotten, is a monetary metal. It's been for thousands of years. In fact, in the US, it was a monetary metal. Uh, I think this time up in the monetary metals is going to be different than the bull markets that we've seen before. Gold went from 30 bucks to 200 back in 1975. Gold went from 103 in 1976 to 850 by 1980. Or it went from 260 in 2000 to 2011. It got up to 1920. But then it had big bear markets at 50% drops. Okay.
Hmm.
Don't expect that this time. I think we're going to probably end up with a sort of crisis globally, not just US, that causes a rethinking of what money is and realizing that fiat money creates distortions. And therefore, let's go back to something that is objectively stable. Meaning, when gold goes up to wherever it's going, which may be 10,000 or 20,000, I have no idea. It depends on a lot of these other factors in the crisis mode that they put the world in. Uh, it's likely to be institutionalized up there. Same with silver. Now, as far as what I think is going to happen right now with silver, we argued a few months ago after we made that spike low in April, which tried to copy the stock market
Hmm.
falsely. Got to 27.50 after having been 35 bucks in a matter of about a few weeks. Much of that occurring in 2.5 trading days. We had that was a cleansing drop that anybody who was week long got out.
Shook them out. Yep.
They're gone. Within hours, most, you were back above 30, 32, 33. Now you had dual highs at 35, October of last year and March of this year, where you dual peaked at 35. We argued that's going to be a triple top breakout in price. But getting back up to the high 34 level told us, one, not only are you going to blow out that high, but we're going to launch an acceleration phase in silver that is likely to see silver trounce gold on a percentage basis. And I think silver likely within the next 2 quarters, or certainly by the end of the year, will see itself in the $60, $70 range. Meaning you're going to double the price of silver from where it is now. The old dual highs in silver that existed in 1980 and 2011, either side of 50 bucks, those are phantom. I think they'll come out so easily. And that's when the vast public will say, gee, what's going on here?
Hmm.
Well, you should have been in already. But I think the surge that takes that out will be very dramatic and very quick, to where if you're not already in this beast, that'll occur so fast you probably won't participate. It's happened before, and I'm not arguing that when that occurs, that's the end of it at all. I think silver could go, it wouldn't shock me to $100 to $200 ultimately. But I'm focused right now on within the next 2 quarters. Similarly, I think the stock market will expose itself the other way in the next 2 quarters, probably beginning obviously next quarter, for example, which is days away. So that's where my focus is. Uh, I think the Bloomberg will tailcoat that to some extent. And I think gold will do quite well. I think gold could easily double, if not more, in between now and the end of the year. Get up to 8,000. Why do I say that? It's an idiot thing. If you go back and look at the history of gold over the last 50 years, there have been a couple eightfold moves on a
Okay.
logarithmic scale. If we have an eightfold, we're going to 8,000. That's
In sorry,
yeah,
8,000 by end of year?
wouldn't shock me. Yeah, no.
Okay.
Now, I'm not
And
arguing that's the ultimate end of it. I'm just arguing in this phase, the acceleration phase here.
yeah, I'm just curious if that were to happen, um, just numerically here, uh, as much as you're predicting that silver could move, silver would only be a doubling. Getting to 8K for gold would be a little bit more than a doubling, and silver tends to move a lot faster than gold does
Yeah,
percentage-wise.
well, maybe
Curious.
maybe I'm wrong on getting to eight then, but because I do think silver is, for example, if you look at a silver gold ratio, we do it a different way than most people. We divide an ounce of silver into an ounce of gold, and if you go back 50 years and plot the highest level that ratio was, where you divide an ounce of silver into an ounce of gold,
Mhm.
21 of those 50 years, it was at 2%. That was almost a norm. You didn't even have to have a bull market for silver to be
Mhm.
2% the price of gold. In bull trends, like 1980 or 2011, in the latter phase of those, it got up to 3, 4%. One
Mhm.
time even 6. Okay, forget that. Just getting to 2%. Right now, we're just above 1%. Okay. I think that the move to a norm of 2%. So if gold goes to, let's say, 8,000, what's 2% of that? And I'm not arguing you got to do, but right now in the next 5 to 6 months, I think silver could easily get to 60. And at that point in time, easily be 2%, if not higher.
Higher.
And I
Yeah.
think the move to get there won't be slow. And that's the important thing.
Yeah. And just so you know, again, another point of consistency, I've had a number of precious
Hmm.
metals, people who are bullish precious metals, some who are very commodity,
Hmm.
that's their expertise, guys like Rick Rule. And, they all seem to agree with my general view of the precious metals market, which I won't beat to death here because folks have heard me mention a lot, but it moves like a whip where gold is the handle, moves first, but moves the least far, and then the middle of the whip is
Yeah,
the mining complex, and then
yeah,
silver is the tip of the whip, meaning it
yeah.
moves last, but it moves farthest, fastest.
Yeah, no, and the miners just, I think the miners will do quite well too over the next year or so in relation to gold. I think they could triple in relative value to gold.
Yeah,
Um, whatever gold does in the next year or so, the miners could do triple that on a percent basis. So my emphasis would be, yeah, we think commodities are going to turn up, but they'll nowhere match gold. Yes, gold's going to continue, but this time the laggards, the wild dog on the leash, silver, is going to suddenly outpace gold. And I think the miners are technically, and we measure this technically, we don't just make a judgment call based on feelings. We actually plot the spread relationship, and technically the miners are breaking out versus gold on a relative basis, meaning
hmm
they're starting to surge. Uh,
which is what those
yeah,
of us who follow this complex had expected, and it was taking a while, but now it actually has
I
begun.
think, well, it's become a little more bleeding obvious in the last several months. Where
Yeah.
GDX, for example, you'll see a day where gold's down 10, $20, GDX is up. That's highly unusual,
hmm
surprises most people. But I think that's about what you're going to see. So if I were to say, where do I put my money for the next 6 months? As bearish as I am on the stock market, I'm not going to short the stock market. I think it's going to be relatively small compared to the percent upside gains you see out of the gold miners and silver. I think it'll to some extent help them because of the asset class flow. Another market to watch, which we haven't talked about yet, is the dollar index. Dollar index is a disaster waiting to happen. Back in March, the dollar index was 104.21 on the close. We turned major long-term bearish at that point. And you look at a price chart that was in the middle of the prior 2-year range, didn't mean anything. Now we're trading at 97 today. It's dropped 7% since the March close.
Hmm.
If you close any month out during this year below 98.35 by a credible amount, we're below it credibly right now with a couple days left in the month, uh, you're engaging a even longer term momentum structure, a 10-year average momentum oscillator. You're blowing a multi-decade uptrend on momentum. You can't see it on the price chart, but on annual momentum using a 10-year average as your metric, you're blowing the bridge over the River Kwai. It's gone. And I think the dollar could easily implode relative to the other pieces of fiat that it's competing with in the dollar index. It's hard to rank that as important. If we're talking about the euro and the yen primarily, uh, they constitute 70% of the dollar index, the other side of it. But I think the dollar could drop from the 90s into the 70s. That will cause major wave effects in other markets. And factor in this, if the major Forex market's been dormant between 2023 and 2024, it was in the 7% range doing nothing. So it wasn't creating waves, impacts. It's the quiet one, we called it. It's no longer quiet. And if you suddenly create fractures and volatility in the major Forex markets, that will have wave impacts on other assets.
I was going to say, if the dollar drops in the 70s, that's going to be seismic.
Well, it will, yes. And the real issue is the ongoing decay in the dollar anyway. It's not just how is it decaying versus the euro and the yen, but because they're equally,
Well, it's how about how
unbacked.
all of those are decaying versus real
Yeah,
rate.
yeah, it's a death spiral for all, but and gold knows that. Uh, Gold doesn't just go up because of a weak dollar, by the way. In fact, the dollar index right now at 97, you go back to when gold made its low in December of 2015, the dollar index was 97, 98. Dollar index has really gone sideways. It's gone up and
Hmm.
down, but price-wise, it's where it was 10 years ago, and yet gold has doubled and then some, tripled,
Hmm.
So
Right.
this will merely help gold. It's not a causal factor. It will put further wind
Well, I
in.
was going to say
Yeah.
this is going to put rocket fuel under the precious
More
metals.
fuel.
Indeed, this
Yes. Right.
happens.
Yeah.
Yeah. All right. Well, look, we got to start wrapping up here, just given the time, Michael. But it's been a fascinating discussion. Very quick for folks, if you are, intrigued, inspired to perhaps, think about investing or investing more in the precious metals complex, and you'd like some understanding of just all the different ways in which you can invest in this space, everything from physical bullion itself to the ETFs to the mining stocks, et cetera. We've got a free guide here at thoughtfulmoney.com/gold that just explains every one to you and helps you determine which ones might be relevant for your interests. All right, Michael, as we wrap up, I got to just ask this question because a lot of what a lot of your thesis is really sort of revolves around this declining deterioration of purchasing power of the
Mhm.
dollar and other fiat currencies.
Mhm.
Where does Bitcoin fit in this, in your mind?
I am sorry, I'm not enthusiastic. We've analyzed Bitcoin since it started in the futures market in 2017, and we've called all of its major moves quite well. In fact, we were quoted by the Wall Street Journal routinely for years as regard Bitcoin. Right now, we see, and this is going to be shocking, we think that Bitcoin has become a coincident mover with the NASDAQ 100.
Mhm.
And it's not moving like gold. It's not moving like an alternative currency, as they like to posture that it is.
Yeah,
It has
moving
a
like a
virtue.
risk-on asset,
Yeah, yeah.
like a
It
hyper
is,
risk-on
it
asset.
is, but it has a structure right now on its quarterly momentum, and you don't see it on the price chart, such that the other day we got to 99 and we're now up to 107. Now the high recently was above 112, 112,000. It's not making a new high like NASDAQ is right now, but it's moving, trying to move up with it.
Hmm.
Next quarter, if you get this beast down into the mid to lower 90s thousands, which actually, if you look at a price chart, is only halfway back to the low we made in the 70,000s a couple months ago. So it doesn't look important on price. You're going to collapse. We have a pending crash structure on Bitcoin such that if you ever return to its rising three-quarter moving average, which you've used 3 times now in the last 3 years as support, when you plot a momentum chart, it's a floor. Price chart, you don't see the floor. Momentum, it's a three bottom floor. It'll be a fourth hit. You will not hold. This is the same overlay chart as the S&P had in 1987 prior to the October crash. So I'm arguing that a market that is now moving in sync with the stock market has extreme vulnerability. And I would argue you don't even want to get back in the mid 90,000s. The trigger number is about 92, by the way, 92,000 for next quarter. So, but if looking at the chart, I wouldn't even want to start moving in that direction again because I think Bitcoin could be an ambush event. And there's a lot of financial companies that are linked to it now, more so than they were 10 years ago. Where if Bitcoin suffers that kind of break, there's a lot of companies that will be injured badly that have heavy commitments in that arena, one way or the other. So it will be the kind of thing that people aren't looking at now, they're comfortable with, when suddenly it becomes a screamer. Again, you got to get to the structure, but the structure's there. And usually when momentum builds a structure that smacks you in the face, it's there for a purpose.
Okay. All right. So given your, general pessimistic outlook for the latter half of this year, you don't think that Bitcoin is,
No,
in your mind, is a good place to seek safety, even
no.
though it sells itself as we're the anti-fiat
Yeah, no,
solution.
no, and that argument I bought years ago. I'd like that. It wasn't controlled by government printing. You couldn't infinitely, at a push of a button, increase double its supply or something because the Fed wants to. But its technical behavior and its emotional behavior lately is become, it's become a government instrument almost. Trump has parties, okay, uh, and it's become frothy, but it has a momentum structure that is quite scary. And it's the kind of structure that I call inevitable. In other words, you don't build that structure not to use it as a breakage point. So it's one of those things that I think when it happens will suddenly ambush a lot of stock people as well, because there'll be connections.
Right.
Yeah.
Okay. Well, look, we're going to have to leave it there. But Michael, thank you so much for coming on. This has been a great discussion. Um, for the people that have really enjoyed this interview, Michael, and would like to follow you in your work, where should they go?
OliverMSA.com, MSA for Momentum Structural Analysis. Tour the site. We explain in some depth our history and also why do we have an unorthodox, very unorthodox technical methodology. And we explain why and how it sort of functions without telling all the secrets. But anyway, yeah, take your time, tool through the site, and request some sample copies, no problem.
All right, great. And Michael, when I edit this, I'll put up the URL to your site there on the
Good.
screen. Folks will also have the link in the description below this video. All right, Michael, look, bear with me just for 30 seconds. I got some housekeeping to do here. Folks, so first off, please show Michael that you've enjoyed him appearing on this channel by hitting the like button and then clicking the subscribe button below. And if Michael caught your attention, as I'm guessing he caught many folks' attention in this conversation about where he thinks the markets are likely headed from here, if you want to get some help in potentially positioning your portfolio in general, given your financial goals, but maybe specifically for some of the potentialities that Michael has laid out for us here, highly recommend most people watching this video should get that help from a good professional financial advisor, but B, importantly, one that takes into account all the macro issues that Michael has talked about here. If you've got a good one who's doing that for you, great, stick with them. But if not, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill it out. These consultations, as I said, are totally free. There's no commitment to work with these firms. It's just a way for you to get free professional guidance on what they think you should do, and you can do with that whatever you want. It's just a service these firms offer to try to be as helpful to as many people as possible. All right, Michael, thanks so much for hanging in there for that. We do have a number of professional investors that watch this channel, but most of the people watching are just regular people out there. They've worked hard to build their wealth. They'd like to grow it prudently, but more importantly, they don't want to lose it into some sort of market dislocating event like you think might be coming ahead here. What's your parting bits of advice for these folks?
Expect the unusual in the next couple quarters. Don't expect the normality, the quiet arm wrestling type action that we're used to in the markets. Expect extreme volatility compared to what we've seen in different directions depending on the market. But I think a lot of noise is going to happen, directional noise that's going to ambush a lot of people, both in their positions and their emotions. And
Yeah, and I think you would say as many, especially the financial advisors I have on this channel, look, forewarned is forearmed. Get your plan in place beforehand. Basically, try to put yourself in a position where you're not going to be subject to your emotions driving your decision making, because that tends to be the worst type of decision making when it comes to your money.
Correct. In other words, anticipate, get comfortable, get safe. Don't fret about every uptick or downtick in the stock market. There's bigger stuff going on here. The stock market is important. After all, when it turns down, that's when you get all the bad data points. Never before. Okay. And that hurts people, the real data points that cause pain and emotion. So I think we're going to get that pain and emotion or joy, depending on the market you're in, over the next couple of quarters.
All right. Well, fantastic. Michael, thank you so much for joining me. Really enjoyed talking with you here and appreciate you coming on the channel.
Thank you, Adam.
All right. And everybody else, thanks so much for watching.